So we'll start with binomial trees, VRM 14. Now let's let's begin with a very foundational idea, okay, which is in fact central to not only options pricing, I'll say, but in general derivatives pricing also. And we have seen it earlier in fixed income securities, if you remember. We have seen the no arbitrage argument. In fact, replicating portfolio, we also solved a gap sample paper question. So the idea is simple. It's the law of one price. According to this law of one price, if there are two portfolios, portfolio A and portfolio B, and if they are providing equal cash flows, exactly the same cash flows in the future, okay, and at the same times, okay, that time dimension is also important. They must have the same or equal price today, okay, which means that portfolio A will be equal to portfolio B in terms of price. Okay, even though it might be different in terms of characteristics, but in terms of price it will be same if this condition is true. See, if suppose they were not same, what would have happened? Why we call this a no arbitrage argument? Because if this did not hold true, price of portfolio A, if it was not equal to portfolio B, then of course any trader could exploit this difference by selling the more expensive one and buying the cheaper one, and that will lock in the risk free profit for the trader, and that is what is known as an arbitrage opportunity. And you know, markets in general tend to quickly eliminate these kind of arbitrage opportunities. Okay, so this is the idea which will be the core of the powerful tool that we're going to discuss today, binomial trees. Okay, so we'll see how they provide a very simple but a very powerful way to I'll say again visualize how this no arbitrage argument or no arbitrage logic applies to option pricing. Also, we'll explore the idea of risk neutral valuation. Risk neutral valuation. See, the approach of risk neutral valuation simply assumes that all investors they price assets as if they expect to earn the expected return is equal to the risk free rate on all investments regardless of the actual risks involved. Okay, so in a risk neutral world the expected return on every asset is equal to risk free rate. And this is also one of the backbones of modern derivatives valuation, because if you remember forwards, futures, we always valued using this risk-free return expectation only, because the compounding factor or the discounting factor for finding out the current value, or the compounding factor to find out the futures value, always used to be the risk-free rate, if you remember from forwards and futures, right? So same thing we'll do over here also. Okay, I think there is some doubt. Okay, fine. It
So,
was
sir,
about
this is the fixed rate of interest.
fixed rate of interest, the risk-free rate of it. But again, it's a
But does
theoretical
this hold
theoretical
true
one.
in actuality?
Actually, this is a very good question, because when I was studying this for the first time, risk neutral pricing, I was not very satisfied, because see, all the investors have different characteristics, different risk return, or you can say perception, and also different utility functions. Some utility functions are the same utility functions which probably some of you might have studied in economics. But anyways, that's not important. The main point is that all investors generally should not have the same expectation, right, from all the assets. But practically, why this is relevant then? If the investors they do not have the same risk-free rate of return, then how this becomes practically relevant? That is also very important to understand, right? This becomes practically relevant because it forms the foundation of many models, and based on the model generated price, in fact it has been observed over many years that based on the model price, the real price also is not very different actually from the model based price. So that is the good part. That is where the practicality comes into picture. So even though the expectation part might not be correct, okay, but still it is very practical, because it has been observed that the model generated price form a kind of a benchmark, okay, for which from which you decide, okay, this the price should be closer to this benchmark. At least you can have the benchmark. Vedant is asking, this concept also standardized different scenarios where risk is different. Yes, exactly. This very good point, Vedant. Actually, this concept also standardizes different scenarios where risk is different. Absolutely. Okay, each investor will have a different perception of risk and reward, right? Some investors will be actually risk-seeking investors. Some investors will want to take more risk, and I should not say risk seeking because that's a very technical word. It means that investors seek more risk irrespective of the return. So I should not use that. But the idea is that some investors want to take more risk. Okay, some investors want to take less risk, and also in an asset, in two different assets, the level of risk is of course different. So this idea that the expected return is equal to the risk-free rate also standardizes this notion. Okay, notion of what? Notion of risk, where we have different kinds of risks. There is a standardization, and again, this also helps in benchmark creations. Okay, risk appetite of different investors is different. Now, see, when we talk about prices, see, there is one thing that expected return is equal to risk-free rate. Obviously, that is not true for investors because absolutely reason risk appetite of everyday investor is different. But then what about pricing? Because the statement that I mentioned, I directly did not mention that the expected return is equal to risk-free rate directly. That's it. No, I also mentioned some background. I said that investors, they price assets in such a way as if they expect to earn the risk-free rate on all investments, regardless of the actual risks involved. Okay, so risk neutral prices practically. Now, the next part of the question to be addressed is, so the first part was this, that of course this directly is not applicable in the real world, but because of benchmarking and theoretical models, this works very well. But as I also said, that pricing has been observed actually in derivatives markets, especially the markets which are very liquid, I should say. Which markets are very liquid, in terms of derivatives? You have, in fact, if you see, one of the largest segments in derivative markets is actually foreign exchange options. Even equity options, definitely they are, but foreign exchange options also are very, very liquid. In equity options, of course, the most developed financial markets of the world, particularly in the US, S&P 500 options, they are very liquid. So in these scenarios, the market price of the derivatives, not the underlying assets, I'm not talking about the underlying assets, market price of the derivatives are generally aligned with the risk-free values. Okay, so it makes a lot of sense. That's why it is a very practical and a smart assumption, I'll say, to have. Okay, fine. Uh, next slide. Okay. Now, today's class is going to be very, very different from what you have seen in the videos. Not in terms of content, I'll say completely, but yeah, in terms of the structure, a lot of things have been discussed in the videos. Again, we'll keep the class very, very exam specific, and we'll add some points, in fact. But
So I had
alongside,
a doubt before
yes,
that.
yes, yes.
What is the difference between value, payoff, and price? I know payoff, but
Mm-hmm.
sometimes it seems that the terms are used interchangeably. Like in the last class,
Mm-hmm.
last Sunday,
Mm-hmm.
when you were teaching the previous chapter, no,
Mm-hmm.
that I had doubt in FRM,
Mm-hmm.
like small c, capital C, we were using for. So, what do we refer to it as? Payoff or value price?
That is purely the price or the premium for the option. I think you're talking about the context of call and put options, American and European,
Yeah,
right?
yeah,
You use small c for Europe. Yes,
yeah,
that was
yeah.
that was the price or the premium that is paid. Now,
So,
this price actually has two components. Okay, I'll just write over here just so that you can take a note. Uh, Doubt from, say, previous class. I just write this. Okay, so you can just figure it out yourself, which chapter and all. but it is actually applicable generally to all chapters of options, right? So basically, when we talk about say C or capital C or P or capital P, this is the price or premium, whatever you call it, because
In
the price is
upper and
closer to
lower
premium.
option price bounds, no, you had taken some examples as
Upper and
well,
lower
right?
bounds again of the price. Upper and
So this
lower
is the
bounds of the
premium.
price, yes, of the premium or the price, because both are same.
Yeah.
When I buy
So it
the
doesn't
option in
refer
the
to
market,
payoff.
no, it does not refer to payoff. Okay. But this
But
premium or value or the option, or you can also say value of the option. Now, this has two components. Okay. One is intrinsic value and the other is time value. Now, intrinsic value actually is the payoff.
okay.
Okay. And time value is something else, which of course depends on how much time the option has to expiry. And the more time it has, there is a higher probability of the option going in your favor, right? Intrinsic value may be zero sometimes because many options which are out of the money, their payoff, of
Yeah.
course, they will not be exercised if the payoff is zero.
Mm,
But still, the options are not trading for zero. The
mm.
options are still trading for some amount. That is mainly because of the time value of options.
Okay.
Okay.
Now
And
what we
again,
have learned that profit is payoff minus premium,
correct.
but
Profit is
but
payoff minus premium. Correct. That
yeah,
is the thing.
but here you have written that premium is also payoff.
Yeah, because see, it's very simple. Now, if profit, I did not say premium is payoff. I said premium is a combination of payoff and time value.
Mm,
Okay. So when we write
okay.
profit is equal to payoff minus premium,
Mm,
right? That is
mm,
because in the end, if you want to calculate the profit, it will be
mm,
payoff minus premium.
mm,
So this is something which you will calculate when you exercise the option. Then the dynamics changes completely. When you exercise the option, this is the profit that you are getting, payoff minus premium. But see, when you buy the option, why both of them are not, because they might seem contradictory over here, because in a way, although this is not pure math, this is pure math, profit equal to payoff minus premium.
mm,
But I'm not saying that premium is equal to exactly payoff plus time value. But still, I can write that, no problem at all.
mm.
So premium
So in that case, premium would be greater than
is
payoff.
equal exactly. So payoff plus time value. So you might find that this is a bit contradictory, right? You may feel that, but no, it's not contradictory
Mathematically.
because yes, mathematically it might seem contradictory. Although I am again saying this is not a true mathematical relation, not 100% true, but still it holds, right? So in this case, you might find that okay, how is it possible? Premium, is becoming actually greater than the payoff plus something, and then when you're calculating profit, it becomes payoff minus premium.
Exactly.
So payoff minus premium in this equation, it is always negative because if you take premium on the right hand side, it will become payoff minus premium, and time value of money will go to the left hand side with a negative sign. So profit will always be negative. You will feel that, but that is the reason why we consider everything from a time point of view. Also, see when you bought the option, then at that moment of time, when you bought the option, say the stock price was something, and because of that, the payoff was $1 only. But when you exercise the option, it is possible that the stock price is already moved up by $5, and then your payoff is much higher than the initial payoff of $1. Understood?
Mm.
So that is why this is not contradictory because it is time dependent also.
It
Okay.
was mentioned that the premium or maybe the payoff or the
Mm-hmm.
value or price cannot be greater than the stock price. I understood that math, but I
Mm-hmm.
was not able to understand in context that see price is the amount which we pay to buy the
By the
option
option.
or
Correct.
correct, and payoff
Correct.
is something like what we get. What is the difference between the strike price and
That
the
is
stock
that is
price?
intrinsic value kind of thing.
Yeah,
Yes.
so
Yes.
that I understood that
Mm-hmm.
payoff can never be greater than stock price because I understood what you taught graphically,
Mm-hmm.
but
Mm-hmm.
uh, but I couldn't understand how can the price be not greater than the stock price.
Because again, if you see the video,
I understood payoff.
you
Payoff
have to
cannot be greater
understand the
than stock price.
arbitrage because there will be again an arbitrage opportunity over there. Okay, you can check the arbitrage opportunity in the video because if suppose the price itself, you are asking that you understood why payoff cannot be greater than the stock price,
Yeah,
but you could not understand why premium is greater than not greater than the stock price.
yeah.
Correct? That is the question. Because
Hmm.
there will be arbitrage, direct arbitrage options. Okay,
Can you
yeah,
give an
arbitrage
example if
opportunity.
possible?
I think it is better to go through the video once for that. In fact, we have discussed this in detail. What kind of arbitrage
No, no.
opportunity?
I understood that video. With
Okay.
the help
So you
of that
understood the
example
arbitrage
only.
opportunity part?
Yeah,
Arbitrage opportunity part is
yeah,
clear?
yeah, yeah, yeah,
Same
yeah, yeah,
example
yeah.
will give. Same example. If suppose you buy an option and
Hmm.
that option's price is greater than the stock's price, then there will be a sure shot arbitrage opportunity if you want to exploit it. Because
Correct,
say
correct.
say you that's it. That's the only reason. Okay, that example is enough. Only the reason is arbitrage opportunity. Of course, the payoff cannot be greater than the stock price, which is very, very clear. But
Hmm.
premium also cannot be greater than the stock price because premium is equal to payoff plus some time value. So we can think that okay, the
No,
maximum
suppose
value of
if
payoff.
the premium if the price of a premium is suppose sorry, the premium is of $10. If suppose I
Hmm.
want to buy an option,
Hmm.
and maybe the
Stock
stock
price
price
is
at
stock price is how much? Yeah.
see $10 is the premium.
Hmm.
Let us consider the strike price is
Europe,
20.
European or American option?
European.
European option.
So $20, maybe 20 euros.
K.
Uh, K
$20. Yeah.
is 20,
Stock
and
price
stock price at that time is 30.
close to 30
Huh.
because yeah, let's say it is 29.
Okay.
Yeah,
And this is a call option.
this is a call option.
Hmm. So
Okay.
suppose it goes to maybe stock price goes to 25.
Now let's consider the case why C cannot be greater than 29. That is the question,
Yeah,
right?
yeah, yeah. Yeah,
Okay.
premium cannot be greater.
This is the question. Okay.
Yeah.
I'm giving the same concept, same example. The same thing. That is why I said for the video, because in the video we have explained why arbitrage opportunity can arise. But anyways, so
When what
let's
happens is,
say,
sir,
yeah.
when I relate that same example with payoff, no, I completely understand it. Yeah, the logic. But when I take in consideration,
For payoff logic, you don't need the arbitrage argument. It's very, very clear, right? You cannot have it. There is no chance. So you don't need the arbitrage logic. It is common sense. It is very easy. That's why you're able to understand it. And I completely agree with that. That's why I said your question is that payoff part is so very, very clear. It should be clear to everyone. No problem.
yes,
But when it comes to premium, then you have to understand the arbitrage logic. That's it. For payoff, again, I'm saying no arbitrage logic is required.
because premium is something that we pay. It has nothing to
Hmm.
do either with the strike price or with the stock price, because payoff
Correct.
is completely dependent upon the stock and the strike.
But
But premium,
premium is also a combination of, I mean, payoff is inherent in the premium. If suppose you have a very strong positive payoff, I'll just give you an example. You said, let's say, I mean, with the same numbers, do you think this kind of call option can have a value of $1? Forget 29 right now. Let's discuss the lower part also. Is it possible? Do you think in market it can happen that the payoff is so high? Because the implicit payoff, if you see, is $9.
correct.
29 minus 20. So do you think such a call option you will get in the market for $1? Is it possible? Is it possible to get such option which is giving you a immediate payoff of $9 for $1? Not possible, right? Practically, it doesn't make sense. That is why when I chose the numbers, I chose it very carefully. You said 30, that was also okay. But look, it has to be close to, not very far away from the payoff. Okay. Or if it is far away from the
Okay, so
payoff,
the
time
current
has to be
difference
there.
should be close to the premium.
Yes, I mean, close to the premium. No, no, the current premium should be close to the payoff, I'm saying.
Sorry.
The
Current premium
current
should be.
premium should be close to the payoff,
Okay, got it.
right? 10
Got
should
it.
be
Got it.
close to 9. That is the idea, right? But even if it is not close, still that is okay. It means that the option has a lot of time. If suppose it is not very close, maybe it's $15, it's too high.
Hmm.
It means the option has sufficient time that market participants may expect that the price of the stock will go even further up. And because of that, the call option is priced a little higher. Okay. But again, coming to the point, why C cannot be greater than 29? Let's take an example. Let's say C is equal to 32. Okay. Now, as a trader, what you can do, you can sell this call option. What premium will you receive?
32.
32. And what is the obligation that you have?
I have to pay 20.
No, no, no. You have to pay 20 in sense. Why you have to pay 20? I mean, what obligation in terms of stock buying and selling asset you have? Let's say you are in a short position in the call option. You have sold the option, right? For 32, you have got 32. Again, we are not considering the practical market scenario where margin and this 32 is also deposited
Hmm.
with the broker. Forget that. Very simplistic assumption. You get 32.
Hmm.
Okay. What is the obligation of the short call position?
I have to sell it.
No, no, no. Just try and recall. Sell it. Sell what? It means what? What is the it part over here?
Option.
No. When you short the option, you have again the obligation with respect to the option itself or the underlying? Long call has the right to buy.
Buy the stocks.
Long call has the right to buy. So short call has
Sell it.
exactly. Very good answer. Yes. Everybody has many, not everyone, but many of you have answered correctly. So if this is the right to buy, short call gives the right to sell. Okay. And just for sake of simplicity, I just want to start with American options because I'll excise it immediately. Okay. So again, this will apply to European also, but I'll start with American to make it more simple. Analysis, I don't want to complicate. So you sell the option and at the same time, you buy the stock immediately. At what price? What is the current price of the stock?
29.
Correct. So sell C, sell call. Okay. So you get
Sell
a
call
cash
option.
inflow. Yeah. Sell call option, you get a cash inflow.
Hmm.
And when you buy the stock, buy stock, this is an outflow, correct?
Hmm.
Hmm. Now, your net inflow, your net cash flow is positive or negative?
Positive.
Positive. So you receive 3 right now, correct?
Correct.
Okay, again, I am saying this analysis will hold true for European also because it can be shown that even at expiry, if if ST is greater than K, the call will be exercised and you will deliver your stock and you will receive the strike price now. Anyways, but let's say right now itself, immediately, if you have the obligation that the option is exercised, okay. So do you have any problem? You already have an ownership of the stock. You already have the ownership of the stock, correct?
Hmm. Correct.
So even if you sell the stock right, even if the call option is exercised right now, is there any problem with you? You already have it, right? You have to sell it for how much? $20, correct?
Hmm.
So you sell it for $20. What is the net cash flow that you are getting?
9.
Again, taking it the wrong way. I'm saying you are not getting 9. You are actually getting
Okay.
20, full come 20 because you are selling. You had already bought it for 29.
Correct.
We have considered this outflow already. So don't worry about this. Finally, what you are getting? 20 more.
Correct.
So what is your total profit? 20 plus 3, 23 without any risk at all. Just because you sold this and bought this, you are just gaining 20. So will the market allow this?
Okay.
Understood. So that is why very simple arbitrage opportunities will present themselves as soon as C is greater than S. Very clear cut arbitrage opportunities. Okay, here we took an example where strike price and K, all these were different. Even in the extreme cases for at the money options also, you will see that at least one more, at least I think I should not say $1, greater than $0 of arbitrage opportunity will exist. So that's a clear cut arbitrage which the market will not allow. Okay. So Nitin is asking how these are controlled in real market situations. In real market situations, such kind of price inconsistencies or will not exist, and that is why we have the upper bound. That is why C, comma C, both of them have to be less than the current market price. Okay, Nitin? In fact, maximum they can be equal to in real market situations. That is the idea. Okay. So is it clear, Parth?
Yes, sir. Thank you.
Okay, fine. Let's continue. So as I said that this chapter will be a bit different in terms of the structure and the content, the total content that we're going to cover. The idea of the content will be the same, of course. Again, we will focus mainly on the exam specific ideas, but we'll use Excel a lot. Okay. And we'll not do calculations manually. We'll try to do them in Excel because manual calculation is already done in the video. So it'll be learning for you as well. Okay. And I will expect, not if not now, after the exam, you will try to replicate those Excel sheets because the today's three chapters, binomial trees, Black-Scholes modern model, and also the Greeks. I mean, we can have very subtle and very elegant Excel sheets. I mean, if you want to prepare, you can prepare them even better than what I'm going to show you because we have prepared it in a very crude and raw way. So you can try to make it even better. Okay. Now let's come to one step trees. Let's just generalize it. Suppose that the price of a non-dividend paying stock is currently S. Okay. And that during a time T, so going forward during this time, so at T I should say, it will either move to SU, and SU we're going to calculate it like this: S multiplied by the upsize factor or up factor. So obviously if it is S times U, say for example, if it goes up by 30%, then U will be 1.3. So obviously the return will be 1.3 minus 1, which is 30%. Okay. So either it can go up or it can go down. Now consider a derivative which provides a payoff of FU if the stock price goes up and a payoff of FD if the stock price decreases. So again, let's first understand or visualize this properly. So I said that we have a stock price initial S. There are two options, two scenarios in front of you. Either the stock price will move to SU, and in that case, the option is providing a payoff of FU or any derivative. In fact, it's not a option in general, it can be any derivative. And this is the down move. Stock price will become SD, and in that case, the option payoff is FD. Now, what we do, we form a portfolio which consists of a long position in delta units of the stock and a short position in 1 unit of the derivative. Okay, where delta is this, where delta is this. Again, if you see the video, you'll understand using the verification what is the idea behind this delta. So I'll just tell you why delta has been chosen to be this particular number, okay, for this portfolio. Because we know that if at time t the value of the portfolio will be this much if the stock price increases because there were delta number of shares, so delta multiplied by SU, and since you were in a short position in the derivative, so that's why you have a minus sign. Okay, and of course the value of the derivative will become FU. So this will be the value of the portfolio when it goes up, the stock price goes up, and this will be the value of the portfolio when the stock price decreases. Now, why this delta has been chosen? Because if you plug in delta in these two expressions, you will find that both these values give you the same result for the portfolio. So the idea is to make sure that the portfolio is guaranteed to have a fixed value in both the cases. That is why delta has been chosen. Yes, if Vedant, when we go further, in fact, when we study option Greeks today, this is actually the same delta, okay, which is also the option sensitivity, the price of the call option, how sensitive it is with respect to the underlying, but that is a later part of the discussion, but absolutely correct. It is the sensitivity of the derivative with respect to the underlying. Absolutely. Ujjwal is asking, binomial and BSM pricing is only for equity options and few others. Can it be used to price commodity as well? See, I think if you tweak it a little, commodities in general, now commodity what? Commodity options, commodity futures. We have to think about that. I think we can try and modify the model a little, but I don't think, I mean, because of the assumptions that we use for stock prices, maybe the commodity, the underlying asset itself may not follow those kind of strict assumptions, or may not even be close to those strict assumptions. Okay, so that's why usual. I think the pricing of commodities or even commodity futures or commodity based derivatives might not be as effective as it is in the case of equity options. Okay, and of course there are a few others also which we'll see today. So again, I'm repeating, for this value of delta, the value of the portfolio at time t for both the upward movement and downward movement in the price is actually same. The value of the portfolio is same irrespective of whether the stock moves up or the stock moves down. Okay. Now again, we have derived the formula and we have shown why that risk neutral probability is equal to something. But in this class, we are not going to derive it. I'm just going to tell you that we had these two cases. If you have the current price of the option is if F, okay, or the payoff which you want to the current premium which you want to find out F. There are two choices. It goes up to Fu or it goes down to Ft. So it can be shown that F is equal to P multiplied by Fu plus 1 minus P multiplied by Fd multiplied by e raised to the power negative RT, where P is this and 1 minus P is this. So P becomes e raised to the power RT minus D divided by U minus D. Okay, so this is a formula which you have to remember, and coincidentally this P becomes the risk neutral probability of the stock of the uh, option giving a payoff of Fu, and by extension the stock price going up, and of course 1 minus P is the probability that the stock price will go down. Okay, it becomes like that just because of our chosen values, the kind of delta that we chose and everything. Under those circumstances, this is the risk neutral probability and it can be used anywhere. So let's take an example. Consider this 3-month call option on a stock currently priced at $60. Okay, some parameters will give you. Upsize factor is 1.5. Downside factor is 0.9. Again, I've taken a very extreme example because generally you'll find that U and D, the relationship is something like U is very close to 1 by D and D is very close to 1 over U. Okay, but in this case it seems that they are very far away, right? Because if you do 1 divided by 1.5, you are not going to get close to 0.9. Okay, but you're going to get close to 0.67, something like that. So even if you do 1 divided by 0.9, you'll not get 1.5, you'll get 1.11. So generally, a better practical value for you would have been probably say 1.15. Okay. But anyways, just to make things simple and more coherent, and to help you understand things, this calculation we have taken. So the first step is just to see what will be SU and SD. So since S naught is 60, SU will be equal to S naught multiplied by U, which is 90. SD is equal to 54. Okay. Now, tell me, if the stock price goes up to 90, what will be FU, the payoff from the option? How much?
28.
28. What will be FD? If the price goes down, what will be FD? FD. If the price goes down to 54, what will be FD? What will be the option payoff in that
To
case? No, zero, because the option will not be exercised. It will become out
okay,
of the
okay.
money. 60 and 54. Okay, price is 54, strike price is 60, right? Sorry, 62. Sorry. I'm really sorry. So strike price is 62 and final price is 54. So option becomes out of the money. FD becomes equal to zero. Now, as I said, you can find P like this. P is equal to e raised to the power RT minus D divided by U minus D. So please send what is the value for P quickly. Send your answers. I'll just be back in a minute. Okay, just have some water and I'll be back. Okay, okay. So we've got yeah, few answers. All of them are correct. Suppose so it's 18.34%. Very good. So of course, what will be 1 minus P? 81.66. So based on this, there is an 18% chance of the stock going up and 81% of the chance of the stock going down. Again, this also has to do with these extreme values because this is so high, 1.5, that the chance, of course, going up is a little lesser. Okay. As I told you that if suppose it was going to be say close to 1.15, then you would have found that maybe P and 1 minus P are also quite close. Something, both will be close to hovering around 50%. One will be 47, the other will be 53. It happens like that. Now, what will be the value for F? I told you it can be shown that F is equal to Fu multiplied by P plus Ft multiplied by 1 minus P multiplied by e raised to the power minus RT. Okay, so if we solve these numbers, this first part comes out to be 5.1352, then 0 multiplied by 0.990. So can you tell me what is the value for the option today? What is the value for the option?
5.0843.
5.08. Perfect. Okay.
Sir, I had query.
Yes, yes, please.
Uh, the one line I didn't understand. We can
Uh-huh.
calculate the value of an option in the stock by calculating the expected value of the option in 1 year as
Mhm.
the probability weighted average of the
Mhm.
payoffs in each state.
Correct,
So, what
correct.
does this mean?
This means simply this statement over here. Just a minute. This statement. See, this is the probability weighted average of the options value after 1 year or after time t at
Okay.
time t. Okay. So P multiplied by FU if it goes up plus 1 minus P multiplied by FD if it goes down. And then you take the present value to calculate its value today. That is the idea. Got it?
And discounting the expected value back to today at risk-free rate is the same thing, right?
Discounting.
Discounting the expected value back to
Hmm.
today,
Correct. This
the
part.
same thing, no?
This no,
Yeah.
this one. This part. E raised
Yeah,
to the power
e
minus RT.
raised to minus rt. Yeah, yeah, yeah.
Correct. Correct.
Got it.
Got it.
Yeah,
Okay.
and yeah, and sir, there was one example. Like
Mhm.
in that example, they had given this standard deviation.
Okay.
Uh,
We'll come to that. It is coming later on. So based on standard deviation, we'll calculate the value. In fact,
no, no.
U and D were
From
given,
that they
right?
calculated. Yeah, yeah, yeah. They
Yes.
calculated U and D.
Correct.
The
Correct.
doubt was not related to standard deviation. It was related to U and D. They
Okay.
have given. We calculate the U and D when standard
Correct.
deviation is
Correct.
given.
Correct. Correct. Correct.
So in the example, no, we can calculate UND as well as in the sorry in the question they have given risk-free rate as well.
Okay.
So my question was, while we calculate the SD and SU and SD, why
Mhm.
do we consider this U and D the factors? Why don't we like multiply it with the risk-free rate? Like
Because see, if
because
suppose
generally what we do is we add the risk free rate, add the fraction to 1 and then we multiply it, no, generally.
see, yes, because see, in any case, I think it totally depends on what is the context of the question and what is given. I think it will be better if if you are able to see the exact question, but you will need U and D uh, to calculate SU and SD without any doubt, right? I mean, if you don't have U, if you don't have D, how will you have SU and SD? How is it possible? If they have given both, then it is redundant information. Then you don't need it. But I think in general, in the exam type of questions, you will have to calculate U and D to find out SU and SD. That is why. That is the plain and simple reason. Okay. Now Vedant is asking. Okay, I think there were two doubts. First, I think Ujjwal was asking something. Just give me 1 minute. I think there's a typo then. If T is given as 1.25, then it is a typo actually. Where is T? T is equal to, yes, this is a typo. This is a typo. It will be 0.25 because it's 3 months. Okay, thank you. And yeah, and you can see that just verify this 0.9901 is equal to e raised to the power negative 0.04 times 0.25 or 1.25. Just check this part, please, if the calculation is correct or not. I mean, I hope
0.25
0 point. So this is correct, right?
3 months.
0.9901. Okay, great. So this was a typo as well. Okay. And yeah, now Vedant, we will come to that how U and D are actually calculated. We'll come to the calculations also in a subsequent slide. Okay, now since we know the value of the call option, we can easily calculate the value of the put option using put call parity. So this was the statement of put call parity. If you have a European put option and a European call option on a non-dividend paying stock having the same value for K and T, then call price plus present value of strike price is equal to put plus stock. So obviously if rates are in continuous compounding, then the same thing becomes C plus K e raised to the power minus RT because this is continuously discounted, okay, is equal to P plus. So if we have C, we can have P directly. We don't need to, make a separate tree for that.
So
Now,
sir, in all numericals we have to assume, no, that put call parity is there.
absolutely. In all numericals, put call parity. I mean, if you have to find the other options price also, if you have one of them, then definitely put call parity is the only way to go in all the questions. Not the only way to go, but the best way to go, most efficient way. Okay. So of course it is quite unrealistic. We used only a one-step tree, right? It is very unrealistic to model the stock price changes using a single step. So what we do to create a more realistic kind of valuation, the lifespan of any option is divided into many steps. Okay. So let's define the length of a tree step as delta t. So again, the same expression, f is equal to the weighted average in the future and then discounted to the present. The only difference is that now instead of t, you are having delta t. Okay. So where p will be again equal to e raised to the power r, again delta t. So just a word of caution I want to throw over here that sometimes it happens that in the exam You calculate P is equal to e raised to the power R T, where T is the total time. So remember, the formula takes care of the fact that that total time is already divided into segments, and the formula uses delta t, which is the length of each step in terms of time, not the total time. So if we have a 6 month option and it is divided into two steps, the model is divided into two steps, delta t will be 3 months, not 6 months. Okay, so it's the length of each step. So these parameters U and D should be chosen to reflect the volatility of the stock price. Now, one of the good models to estimate U and D are simply these. U is equal to e raised to the power sigma square root of delta t. D is equal to e raised to the power negative sigma square root of delta t. This is how we calculate U and D, Vedant. Okay, plain and simple calculation where delta t is measured in years, which is again the length of each step. Now, if you look at the numbers carefully, these two expressions, these two equations, you will clearly see that U and D, they are related, right? You can see that D is nothing but 1 over U. It's very clearly visible over here. Okay. So let's just go to a question. So let's say the price of a non-dividend paying stock is 29. Volatility is 25%. Consider a European call option with a strike price of 30 and a life of 1 year. Let the continuously compounded risk-free rate be 3% per annum. Okay. So can you tell me what is delta T? If we are going for two steps, what is delta T in this case?
6
6 months, correct?
months.
Which is how many years? You have to express it in years, right? So 0.5 years. That is the idea. Okay. Can you tell me what will be U? Okay. I'll give you U. You can tell me D. So this is U. What is D? Quickly tell me what is D.
0.837.
Okay, so 0.83 something, yeah, so it will become 0.838. Okay, so this is P, a probability of up move. Can you tell me how much you'll get as P? And I hope even during practice or classes, everyone is, even for simple these calculations where the financial calculator and also other calculators will give you the same result. You're not using any other calculator. Even to practice for every single calculation, however basic it is, make use of the financial calculator only.
0.5007.
5007. Okay, is everyone getting the same result?
0.5007.
Okay, one or two more answers, please.
Sir, 0.4983. When I've got the same
4983.
as
Okay,
usual.
okay. One more answer. Okay, I think in the chat box also we have one answer. Okay, 0.498349. Okay, so close to 0.4984, right? 4984. Okay, so if this is 0.4984, 1 minus P will be 0.5016. Okay, now based on just these parameters, please remember the values. Let's straight away move to Excel. Okay. In fact, in Excel also we have mentioned these parameters. So yeah, is it visible? The Excel is visible. Let me know whenever it is visible.
Yes.
Okay, fine. So yeah, the asset price was 29, strike price was 30, volatility 25%, risk rate was given as 3%, right? And maturity was given as 1 year, and based on that, we calculated delta T to be 0.5. Okay. U we have already calculated and it has been shown here also. Okay. The calculations have been shown here also. U e to the power sigma square root of delta T and D is equal to 1 over U. P has been calculated again the same way. Okay. E raised to the power R delta T minus D divided by U minus D. Okay. Then we have 1 minus P over here. Okay. So let me do one thing. In fact, let's just for one case, for not for put option, what we can do, we can uh, let me check. Okay, fine. So what we can do, instead of having these numbers over here, okay, since we already have the payoff for the option as this and also discounted value, and in this case, simply the payoff. Okay, fine. This is the probability weighted average. So see what we can do. Let me just delete this part. Okay, sorry. Okay, let me delete this also. Only for call option, we're going to do it ourselves completely. So obviously, this is equal to how much? This is equal to D18. You can fix it by having a dollar, but since I'm not going to drag it, I'm going to input the value separately. I'll not use F5 or F4. Okay. So I'm not going to keep it fixed because I'm only using it in a single cell. Wherever you want to use it again, I'm not going to drag the formula from somewhere else. Okay. So I'll enter into a fresh way. So D18 multiplied by U, right? Simple. Let's keep it simple. That's it. 34.61. Okay. Just see how we are getting the values. Again, let me just do one thing. Let me delete everything, in fact. Yeah, that is better. Okay. What we can do, just a minute. Xlam is not working. Okay. Okay, we'll not use it anyways. Any pop-up showing to you guys Xlam not working or not found, something like that, yeah, on the screen? XLAM not working or anything? No. Okay, fine. Anyways, we are not going to use any kind of script or something like that. So we'll keep it as simple as possible. Okay. So as I said, this is nothing but this multiplied by this. So you can just understand every step. That's why I'm doing it. Okay. So this is going to be 34.61 in the up move. What about down move? Is equal to, I mean, and you are free to participate. You're free to tell me the cell numbers. Okay. The cell locations is equal to 29 multiplied by DN. Anytime you can speak, no problem at all. Okay, it will be good for you only. Fine. Next, again, this is equal to this multiplied by u again.
1.9,
Yeah,
1/9.
correct. So it will 41.3. Now this, of course, is same because if you either go through this route, let's say you go up and then down by, u is equal to 1 by d, d is equal to 1 by u. So obviously if you multiply by u and again by d, you will end up in the same location. So you can say is equal to this multiplied by the downsize factor. So which will again give you 29. Okay, even if you use this route, 24.3 multiplied by upsize factor, you'll still get 29. Okay, what about the last part? So I'm just modeling for the stock first. This multiplied by which number or which cell?
1.183.
Oh, no,
0.83.
down move, down. Okay, yeah, it's
0.83.
0.8, 20.36. Then what we do, we go to the last time point that is at t is equal to 1. So as of now, we are interested in this column. Okay.
Are
Yes. Anything you wanted to say? Okay, no. So in this column, it is very clear. Now that option is expiring. Okay, so you will choose either to exercise it or not to exercise it. Now tell me one thing in this case, I mean, since also let me just write down just to make sure that you guys remember it. The and of course you remember it, I know that. So just to make it easy so that we can have it on the screen also. What was the payoff structure of a call option for a long position? Max of what was the formula?
S minus K, comma 0.
S minus K comma 0. So what we can do, we can write the same thing over here. Max of x s minus k comma 0. Correct? We can do that. So let's just write uh, is equal to max function we have. Yes. So s minus k. This is s now minus k. What was your strike price? Where is the strike price? Which cell?
30.
Correct. D5, right? 30, comma 0. 11.3 is the payoff. Okay. I think by mistake you calculated on the basis of 29, Ujjwal, right? So yeah, it will be 11.3. Correct. So the same thing we can apply over here also. Max of s minus k comma 0. So it will, of course, it will come out to be 0 only. Okay. And that is why fixing would have been, a little better because then we could have dragged the formula. But I told that I'll not fix it. Anyways, I'll just copy it and I'll paste it. Sorry. And I just changed the entries. So it will be max of, not instead of H14, you'll have H18 over here, right? So is equal to max of this. I just want to remove this and I'll have H18. Yeah. So yeah, 0. Okay. Acha, the problem is that the same thing is going there. Acha. Take, I'll not copy it. Anyways, it's okay. Hardly it'll take some time. But it'll be better. You'll understand it step by step. Okay, but in when you prepare the Excel, of course, those of you who are very proficient with Excel, you know that we don't need to do this every time. So the second case also max of 29, 29 minus 30 comma 0. So what should be the answer?
0.
0. Perfect. Okay. So in this case also, in the last case also is equal to max of 20.36 minus d5 comma 0, which gives us again 0. So we have the option payoff at t is equal to 1. Now what we do at every point before it, okay, we find out the discounted weighted average and then its discounted value. So to find out the options value over here, the first thing that we have to do, the first thing, we need to make sure that we are finding out the weighted average value of this part. Why? Because this node can only branch out to either up or down. So as of now, we are only interested in this part of the tree. As of now, we are only interested in this part of the tree. Okay. So for this part of the tree, what is the weighted average of these two payoffs? If we want to find out the weighted average of these two payoffs, we have to use the probabilities as well. Okay. We have to use the probabilities as well. So P multiplied by, let me just write it down, is equal to P is this cell, right? Okay, G6, right? Multiplied by, we have H15 plus 1 minus P, which is this cell, multiplied by this value. So do you agree we get the weighted average as of now? Only we have got the weighted, we have not discounted it. But you have to bring it back to t is equal to 0.5. This weighted average is at t equal to 1. Now you have to bring it back to t is equal to 0.5. So what do I need to multiply it with? Tell me.
E raised to power minus RT.
Correct. So exponential minus RT. So minus RT. Where is R? Risk-free rate over here. Okay, 0.03. So negative R multiplied by what is delta t? Actually, it should be delta t, right? So what is delta t? 6 months, right? So over here, D9. Okay. So this is the idea. You're going to get 5.55. Okay. In fact, I think this cell also should be deleted. The formula is already there. So 5.55. Okay. Same thing we do over here. Same thing. So is equal to p times this plus 1 minus p times this. In any case, can you tell me, do we even need to do the calculation over here? If both
So
of them are equal to 0,
0.
we can simply write 0, right? Finished. Okay, now again, at this node, we will follow the same logic, but now we are only interested in this part. So tell me, how should I write the weighted average quickly? Is equal to, quickly. You guys only tell me. What should be the answer?
P into 5.55 plus
So I
1
think the
minus
formula
P
is
into
already
0.
there. No way to delete it. It's equal to T into 5.55, right?
Yeah.
Plus
Plus
1 minus P into 0.
1 minus P multiplied by 0. Correct? This 0. Okay, now I have the weighted average at t equal to 0.5, but now I want to discount it back to t equal to 0. So what should I multiply it with again? E
exponential.
exponential minus RT, this R delta t, sorry. So R minus R times delta t.
D9.
Yeah. So we get 2.2724, and this is your value for the call option. Okay, this is the idea. Now the same steps have been followed for the put option also. The only thing is that the difference is that instead of max s minus k comma 0, we have used max k minus s comma 0 over here. You can see that, right? It is actually k is first. D5 is actually the first entry over here. Okay, it is clearly visible. D5 is the strike price, k minus the stock price. Okay, O14 is the stop. So I'm not going to do this once again. You can do it at your end after the class or after the exam. But this is the idea. Now what we do, we have got the call option value as 2.724. We have, acha, Ujjwal has asked one question. Yes, Ujjwal. 2.2724 is the price or premium you have to pay to buy the option. Absolutely. It is the premium that we have calculated. or the value of the option. Okay, although again a very simplistic model, two-step model is also very simplistic. So in market, it is not used. The Black-Scholes is only used. And in fact, we will discuss the nuances of that also, that how volatility is the main uh, picture actually of the Black-Scholes model, main character I should say of the Black-Scholes model. If Black-Scholes model is the movie, then option price is not the main character actually. The main character is the implied volatility. We'll come to that. So this is the price of the call option, or this is the price of the put option. Let's say we want to verify put call parity. If we want to verify put call parity. So for long call, basically, what is the value of the long call? Is equal to, we just enter the value of the long call, this 2.724. Okay. You remember put call parity had C plus present value of K. So how to calculate present value of K is equal to
K
K
into
price, correct. K into,
E minus RT.
correct. So K into exponential. Okay, now tell me one thing. In this case, what should be T or delta? We should use T or delta T. Should we use T or should we use delta
T.
T?
T, sir.
T. Because now we are talking about 1 month, 1 year and call option and 1 year put option directly, right? So don't get confused. That delta T was only for the steps of the tree. Okay. In this case, now we have calculated everything. Now we want to verify the relationship between a 1 year call option and a 1 year put option. Okay. So negative multiplied by maturity now. That is the idea. Okay, so these things are very, very important. Okay, so this is 29.113. Okay, now let's go to the long put is equal to, this is the value of the long put. What is the value of the long stock? What is the value of the long stock? Current value. How much? Quickly. Long stock. What should I answer? Enter quickly over here the number. See the figures and tell me. It's quite obvious.
41.30.
No, because this put call parity we are verifying today. Try and understand. It's a 1 year call option, but 1 year haven't passed. This was the model where we, chose that okay, if something happens, the stock price will be. What is the current stock price?
29.
29. Okay.
Okay.
So is equal to 29. Now, put call parity says that the sum of these two should be equal to sum of these two. So if you calculate the sum of these two, how much you're getting? 31.838. And if you calculate the sum of these two, this plus
Should be
this,
equal.
you are still getting 31.838. So
So
put call parity is also verified. Okay, fine. Now let us go back to our PPT where we were doing European call option. What if we have American options? Now, for American options, they can be exercised, right? At any time. So the calculations will change. What will be the change? At each node, we will have to do two calculations. We'll see how much the option is worth if it is exercised at that node. So the same payoff calculation that we were doing, no, not this one, sorry. This is the payoff. And this is the same weighted average discounted value. How much the option is worth if it is not exercised. So this part we were also doing as, or also doing in the European case. Okay. This will be the current payoff at each node. Okay, so again, to understand, and of course, the value of that option that we have to choose for that particular node will be the greater of these two. Okay, so again, we can go to the Excel quickly. So we had verified the put call parity, and now we have the American ones. Okay, the American call and put option. So now what we are doing in this case, see, we are calculating, you can see that we are doing two calculations at each node. Okay, and then we are taking the greater of these two values every time. So you'll find that for call option actually it did not make any difference, but for put option there was a node where it made a difference. So rather than call option, let's analyze the put option on Excel this time. Okay, because in this case there was a situation where expected value was 5.25 but payoff was greater than 5.25. So instead of 5.25 we actually chose 5.7 for that particular node. Okay, so call option I'm not going to do it once again. Put option we're going to analyze right now. Okay, so again let's just delete all the numbers. Okay, yes, so we have everything is gone in this case. Fine, so time node 0.0, or you can say this, we are calling this as node A, right? So this is node A where we had the current stock price as how much? 29. So this is the current stock price. Okay. Now we go up one step up. So these things will not change. Of course, S times U and everything, these will not change. So let me see if we can get the same results. Yeah. Oh no. Full V. So 29. And then, so I'm only copying the value of the stock at each stage. Okay. So that will not change. Correct. That is why I'm not calculating them once again. So they will be the same. Now, at this point, at node D, this is B, this is C, this is D, E, and F. Okay. Now quickly tell me at node T. Now over here, you don't need to find out the weighted average or discount because this is the time to maturity. In any case, if the option you have held till this point, either you will exercise or you will choose not to exercise it. So here also in this last node, the calculations will be same as European. So quickly tell me for a put option with a strike price of 30, what is the payoff in this case? Max
0.
of, yeah, sure. What should I write? Max of K minus S, correct? So this minus S comma 0, which is actually 0. Second case, what is the payoff?
0.
Zero.
So put option, strike price is
Strike price
30.
is 30.
Current,
1.
correct, absolutely. 1. Okay. Last case, what is the payoff?
9.6 something.
Okay. Minus 9.6365. Okay. Now, at each node, at node B, first, let's calculate the expected value. This is the expected value, guys, 0.49. So same calculation as the European one. So again, we'll not do it once again. The same thing, weighted average multiplied by e raised to the power minus RT. Okay. So what I can do, I can I think I have to just check the settings also once. I just see what I can paste. So paste formulas, no, no, just a minute. Anyone has any idea? If I just want to simply copy the numbers, I think there's a paste value option also. Why are we not letting it? Yeah, now it's okay. Value and source formatting. So 0.49. Okay, the same calculation that we do over here. At node C also, uh, okay, anyways, I think we should just understand that first we can check because we only have one entry over here. So this we are going to choose greater of exercise value and expected value. So let us start with node B for put option. Again, I'm repeating node B. So expected value is 0.49. Okay. But payoff if exercised today. So if at node B the option is exercised today, the asset price is 34.608. What will be the payoff if the option is exercised today? With a strike price of 30 for a put option, what will be the payoff if it is exercised today? Quickly, I'm going to delete all these again. Yeah, then we'll calculate. What will be the payoff if the option is exercised today? Come on, guys. So simple. Okay, I've got a lot of answers on chat. Sorry. Okay, okay. If it is exercised today, Vedant, what is the payoff? 4.608. No, it's zero, right? Max K is how much? 30. Max 30 minus what? 30 minus the stock price, right? Which is this, comma, 0. So 0, put option, right? So what is the greater of these two? 0.49. Okay, so even for greater, I can use the max function once again. So max of this, comma, this, whatever max value I'm getting, I am choosing this. And this number actually will go over here. That was the idea. Okay, so I'll just do paste values and formatting. Where's the value and source format? 0.49. Okay, now coming to node C, what is the expected value? Weighted average again we have to take at node C. We have to take the weighted average at node C. Okay, weighted average at node C.
P into
P into, so yeah, P multiplied by what? Tell me what? P multiplied by?
Delta T.
S naught.
No, no, no. P multiplied by what? I mean, we have to take the weighted
S
average
S naught.
of the options payoff. No, no, no. It was P multiplied by FU plus 1 minus P multiplied by FD.
FD. Yeah, yeah.
Yeah. So we are talking about node C. We are talking about node C. So we are interested in this region.
29.
1, na?
1, 1. Okay. Yeah.
Option
Yeah.
payoff is 1, right? So P multiplied by 1 plus 1 minus P multiplied by what? Perfect. 9.6365. Very good. And then this should be multiplied by what? To discount it, e raised to the power minus r delta t. Correct. So e raised to the power negative risk-free rate multiplied by x, which gives us how much? 5.25 is the expected value. Okay, what is the payoff if the option is exercised today? Is equal to max k minus s. Okay, so k is how much? 30 minus s. What is s? What is s at this point? For node C, what is s?
24.
Perfect, 24.301. Very good. So this comma 0. Now comes the interesting part. What is the payoff if you exercise today? 5.7. So which one will you choose? Will you choose to exercise the option today or will you choose to wait? Very good. You will choose. I mean, theoretically, again, this is theoretical because you find that the expected value is 5.25, which is less than currently what I can have, 5.7. Okay. So definitely you will go for the greater of these two. So the greater of these two is equal to max, just writing, of course, it is 5.70. Just to make it clear, we are taking the greater of these two and we are getting 5.7. Okay. So in this case, it will simply be 5.7. I can write it. I'll not copy it because again, yeah, 5.7. So I took this one. And in fact, let me just take the color of this cell also. Light over here. Yeah. So we have 0.49 for this node we chose, which was the expected value. Payoff was less. But over here, payoff was more. So we chose the payoff value. Now, to find out the present value today, it's very, very simple now. Okay, the same idea again. At node A, what is the expected value? Come on, quickly tell me. If I want to find out the expected value at node A is
P
equal
into
to what? Very good. P multiplied by?
0.49 plus 1 minus P into 5.7.
Very good. P multiplied by 0.49 plus 1 minus P multiplied by
5.7 into
5.7 and then discounted. Excellent. So let's do it. Is equal to P multiplied by the FU plus 1 minus P multiplied by FD multiplied by e raised to the power negative RT. So exponential, again, same thing, negative R times delta T. So this gives us how much? So we're getting expected value as 3.06. What will be the payoff if option is exercised today? Put option. Very good. It will be equal to max strike price minus S comma 0. Okay, so payoff is 1, expected value is 3.06. Will you choose to exercise or will you just choose the expected value? Correct. So what should I take? The greater of these two is how much? Perfect. 3.06. So that's your answer. 3.06 is the value of your put option today. Okay, Bukula, you're asking, can we do it in the calculator? Definitely, we can do it in the calculator. And in fact, in the main video, we have used the calculator only. Okay, sorry, Nathan is asking. Yeah. Okay, Nathan, in the main video, we have done calculator only. So don't, of course, we can do it. That's why I said today's session is going to be very different. We are focusing on the crude calculations using Excel. And in fact, this perspective will also make your job easier in the exam because if you see the manual calculation using calculator also, then in Excel also, it's not that you're not learning how to do it manually. You are still learning. Every single step is being clear, right? So the concept part, the steps, how we are performing the calculations is also very, very important. So is American options clear to everyone?
So I have a doubt.
Yep, please, please.
So, sir, in node B, when the price of the stock moved from 29 to 34,
Mhm.
so the option was priced at 0.49,
Correct.
right? So is this the intrinsic value only, because the payoff is actually zero here? So whatever 0.49 is remaining, is it the only the time value remaining?
Generally, I mean, as per convention, I'm telling you, generally, intrinsic value generally refers to the payoff, generally. Okay. But again, there are different viewpoints on this. So, yes, if intrinsic value refers to the payoff, then this 0.49 is purely because of the time value.
So, sir, why there is no time value for call option in node C when the price
In
went down?
node, in node C,
C,
this part, right?
because of the option pricing.
Because see, it's a very good question actually. Why there is no time value? Okay. See, ideally there should be time value. Ideally, it will never be zero. Never. Market will not allow it to be zero. But why it is still in this case? We can in fact uh, answer it by seeing the numbers in the future from node C. So from node C, irrespective of whether even if you wait, it is guaranteed that whichever route you take, what will be the payoff finally? What how much you're going to get from call option?
Zero.
Avyank. That is why.
Zero.
That is why time value is zero. Because even if you wait, Avyank, as per this model, ideally it will not be practically again I'm saying it will not be true. Because practically there will be chances of the option ending in the money. So there will be some time value. But in this case, the model tells you that even if you wait, Avyank, there is no use. Got it?
Okay.
So it's a very good question from your side. And this can be seen in the beauty of the calculations only because time value is completely ruled out in this case because finally whichever route you take, you get the options value as zero. And that is why this model is not practical at all. This is a very simple model because see, actually you have in fact, when we talk about the Black-Scholes model, it is nothing but an infinite extension of this model. You have divided the entire time step into infinitesimally small units of time. Okay, so you have kind of infinite steps, and definitely, Aviyank, there will be many such steps, even if the final value is coming out to be close to zero. Okay, it will never be equal to zero, and because there will be many steps which will start forcing the options value to something more than zero. Okay, that is the
Okay.
idea. Now, and see, one more counter argument, in fact, you could have given from your side, is that sir, even if we have infinite steps, let's say in this case, still, if the final payoff we are choosing this in terms of payoff only, then still, I mean, it doesn't make sense. In the previous nodes, since the previous nodes depend on the final node, the previous nodes will always be zero. But again, the catch is we are not only talking about this part first. This is an implication of the stock's price, boss. The stock's price will make sure the kind of variations we will have in the stock price and the number of trees in the final time point also, because in the final time point also, if you have say infinite trees everywhere, so it means that even in the final time point you will have infinite options, and many of those infinite options will be the cases where the stock price will be above the strike price, which will make sure that the payoff is not zero. Okay, it will be greater than zero. Although the probability will be very small, but when you talk about infinite options, even small probability events happen over there. You can relate it to the normal distribution. See, in the normal distribution, we know that observing an outcome, say more than say, or you can say beyond four standard deviations, is going to be very rare, right? Hardly you'll have some probability 0.00 something, right? But still, is it exactly zero? No, there is still some probability. So even for low probability events, this Black-Scholes Merton model, okay, which will take care of these infinite outcomes, at least theoretically infinite outcomes, will make sure that you have some places where the option ends up in the money, even if the probability is very, very low. That's the idea. Okay, fine. Excellent question, I'll say. Now let us go back to PPT. Now this part I'm not going to explain at all because it's the same structure, same thing. The only difference is that now you have a dividend yield of Q. So the formula changes to, instead of R, you have R minus Q. And if you remember my first analysis of this part and the logic that I gave in the beginning when we were doing valuation of forwards and futures, I told you guys you don't need to remember the formulas. You just need to understand where is the income and where are the costs. Very good, excellent, Vedanti Ujjwal, correct. Income subtracted, costs are added. So this was an income, right? Subtracted from everywhere. In fact, not only from this formula, everywhere you'll see the same thing. Okay, this also foreign risk-free rate is considered as an income. So again, subtracted. Okay, options on future. Now in this case, Q becomes equal to R. Okay, so that's why R minus Q is equal to 0, and any real number raised to the power 0 is actually equal to 1. So E raised to the power 0 is equal to 1. So that's why for futures you have this probability. Everything else remains the same. Everything else remains the same. Okay, fine. That's it for this lecture. Any doubts? Only in this chapter. Only in this chapter. Okay. So even
Hello,
though yes, please go ahead.
sir. If I can just read out the numerical.
Yeah, please. Absolutely. You can.
In the first example, we could have created a perfect hedge had we sold one share of stock short at $100 and
Mhm.
purchased two call options. No matter which way the stock price moves, the hedged portfolio will be worth $50. So they have shown that how it is
See, it is very
always.
difficult if I'm not able to see it because there is a limit to,
Yeah,
understanding
yeah,
of.
got it.
So it's
They
better
are
that,
saying they sold one share of stock at $100 and they
okay,
are buying two
give me
call
the
options.
points. Yeah, give me the points. What exact points are there? Okay, one by one, we'll just note them down.
Hmm.
Okay, and then we'll try to solve it. So
Hmm.
sold.
One share of stock short
Okay,
at $100
okay, 100. Okay, fine. Then,
and the hedged portfolio. I don't know what they've
Mhm.
written and purchase two call options.
Okay.
I don't know what is the price. Maybe it is $50.
It's not
What
mentioned over there. Long two
they
call options.
what they are trying to say is the hedged portfolio will be worth $50 always. So maybe I think so. If they are selling the share, they are long in two call options. So what they are trying to say is the portfolio will always be $50 worth.
I think there should be some mention of delta also in this case because it's the same idea that we discussed in the beginning.
Yeah,
That
this is related to delta.
exactly, yes. So you have certain number of stocks, and you have, in fact, in that case, we were choosing delta number of stocks, okay, and we were choosing one unit of the option.
So what they have written next, no, if the
Uh,
stock price falls to $50,
uh,
options will have zero value. So the net asset position in the gain on short sale will be 100 minus 50 is equals to 50.
okay, it is definitely related to that only because it's the same thing actually that we discussed. Do one thing, just uh, give this question on the doubt forum. Okay, I'll give you a detailed solution or
Okay.
any kind of input you want. Specifically, you can ask over there, and I'll give you my input. Don't worry.
Is it possible to share image?
Right now in the
No,
forum,
no,
yes.
no, no. Yeah, yeah.
Yes. It
Forum.
is possible, but only using laptop. On the app, image sharing is not enabled as of now. But
Through
on the
website.
web, it is available. Yes, you can just share
Okay.
take a screenshot.
And
In fact,
sir,
I encourage this to many candidates that if you have a doubt from say some other source also, and you're not able to say type so much and all those things, tables are there.
yeah, yeah,
Take a
exactly.
screenshot, yeah, take a screenshot, paste it over there, and mention the chapter. Just make sure that
Yeah,
you
yeah, yeah.
do it in again the same
Got
chapter.
it.
That is very important.
Maybe
Yeah.
the lecture objective or lesson objective also can be mentioned.
Yes, absolutely. It will be
And sir,
better.
yeah, yeah. And sir, can you do you have the slide for American put option? Like the
American
way you
put
taught it,
option.
the way you taught it in the class, that
In
recorded videos.
in the video. Okay, okay. Okay, let me check. Let me check. Give me 1 minute. Okay, I'm sharing the screen. I think I have it. Okay, just see if you're talking about this one or not. Let me know. This one, Vedant? Sorry, Parth.
Yeah, yeah.
Which slide?
American option slide,
Okay,
where you decide whether value or payoff, which one we
okay,
have to choose,
okay,
which one is
okay,
greater.
okay. So yeah, those who were asking about the manual calculations, they can clearly see that we have done everything manually over here, everything, and color coding also we have tried to do as much as possible. Of course, it's not possible to that extent, but yeah, we've done everything manually. Okay, yeah, for American options, yes, please.
Yeah.
This, yeah,
So, sir, the stock price is 29. Then we
Mhm.
multiply it with that factor. Then it
Correct,
goes to 34.608. Then
correct,
again we multiply it. It goes to
41.6.
41.301.
Correct,
Okay.
correct, correct.
So in that uh, the video, no original video,
Mhm.
pre-recordings
Mhm.
of the class.
Mhm.
You there were some two options like suppose here maybe the payoff is let's take the lower side, the
Mhm.
payoff on node C at node
Mhm.
C is 5.698 and
Mhm.
at F it is 9.635.
Mhm.
But in European options we can only I mean
I think this was not the
exercise.
payoff. This was the payoff. Yeah, correct. And
Yeah, yeah.
one of them was and these are the also the payoffs. And then we had the expected value also in this case.
Huh, huh.
Achha, this year, okay, this is only the payoff. Sorry, stock values and payoffs. Yeah, please go ahead. Please
Yeah,
go
yeah.
ahead.
And in European, I know that we can exercise only at either at D, E, or F. But in American, we have of exercising it at B and C as well, right?
Correct.
Hmm.
B and C and
So
A also. A also.
yeah, 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 A as well. So you had did something. Maybe just correct me if I'm wrong.
Mm-hmm.
See this 9.635, we got
Mm-hmm.
it. It was
Mm-hmm.
discounted. Okay. And after discounting, we got a values closer to this value, 5.698.
No, we got a value of 5.25 after
Okay.
discounting.
Discounting 9.635. Correct?
9.635 and 1. If we discount the weighted average of 9.635 and 1, then we get, and then we discount it, we get 5.25.
Okay. We
Yes, over here
discount
you can see
the.
that. In fact, yeah, this one.
Ha 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 ha. Correct.
5.25 is the, so if not exercised, FC is equal to 5.25. If exercise, FC is equal to 5.7. And that is why we chose 5.7.
So we choose to exercise it at C.
Yes,
Correct.
we choose to go for the
That was.
exercised value at C. Correct. That is
Mhm.
the optimum position. Okay.
Because if we exercise it at C, we'll get this much
You'll get higher
premium,
value, correct, as
higher,
compared to the
higher
discount.
payoff.
Correct, correct. Higher
Uh,
payoff as compared to the discounted value, expected value.
that was the only doubt which I
That
had.
is the idea. Okay.
So
And
this thing completely covers the American put option, no?
completely American put option. Yes,
Okay.
completely
Suppose
covers.
if I don't understand in this example, no, I'll maybe
Mhm.
post it.
Sure, sure, absolutely, absolutely. And in manually also, it has been done quite beautifully.
Yeah, yeah,
And
yeah.
as I always say to all the candidates, I'm saying that those who have not watched the videos, please make sure because the details again in the pre-class recordings are more as compared to the class rate. The details are more, but in the class again we try to go for the exam specific part in more detail and focus. Over here, we talk about everything, not only things which are important from the exam point of view, but also some derivations, something which maybe after watching that you may have get some new mathematical perspective also. That is also important. And if we watch the video and then we attend the class also, I mean, I'm telling you, you can be almost, of course, question solving and everything has to be done. But in terms of concepts, if you go through the video and attend the class, then after solving the questions, you can be almost 90% sure that your chapter is complete. Okay, so the good part is that class does not only act as a revision kind of thing, but it also gives you a lot of new ideas, because the same question we are trying to solve using some other techniques or using some other tools. We are not doing everything manually. We are not, deriving every single thing. We are focusing on the important parts and also getting some new perspectives from the discussions that we are having. So, the kind of questions which are being asked, uh, since the last, I'll say, 6 or 7 classes, in fact, it has been very consistent, that the quality of questions is actually very good. And don't worry about that. Don't worry about the quality again. I'm saying that that is not at all for you to, worry about. Whatever comes in your mind is actually a good question. That's it. Okay. Fine. So,
So, sir, is it always necessary to take the average and then discount it?
weighted average, yes.
Like I have to add one and point nine, sorry, one and
Yeah.
9.635.
Once, yes, not add, take weighted average of that. Don't add them. You take the probability weighted average. Just like we did in expectations, QTA 3, when we studied expectations for the first time, and in QTA 4 also. Then in expectations, what do? We find sigma PIXI, correct?
Hmm.
So the same thing we do.
Okay.
It is very important because, see, if the probability of an up move is not the same as the probability of a down move, they are different. Obviously, you have to give a higher weight to that outcome whose probability is high, correct?
Hmm.
That is why, rather than a simple addition, we do a probability weighted addition. That is important. Okay.
Okay. And sir, can you go to the first slide?
Yeah. Of this one only or the
No, no,
class?
the
Class.
previous one, the class, live class,
Class one. Okay. Let me just share it once again. Yes. So
where you had taken that example
this
while
one.
explaining it to me.
This one.
No, no, no. First slide when I had asked a question related to FRM.
Okay. This one.
Yeah, yeah,
This.
this one. So, what question I had was, you said that the option was sold at 32,
Hmm.
correct?
Hmm.
So, after selling the option, why am I liable to sell the stocks like at
Because you
29?
are in a short position, if the long chooses to exercise,
Hmm.
you have no choice but to honor the obligation. That is
No, but
the
the option is bought by someone else. No, now he has the obligation to.
no, 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 no. If you have the short position has the obligation. If the option is bought by someone else,
Uh,
then if that long position, because whoever has bought the option is in the long position.
Correct,
So if the
correct.
long position chooses to exercise the option, you have no choice but to honor the obligation. You are in a short position, and
No,
that
no,
is why
I
you
got
get the
it.
premium. Yeah.
Okay. Okay.
See, why are you getting the
No,
premium? Tell
got it.
me. Why is the
No,
long
no, no,
position
no.
paying you the
What I
premium?
was thinking that I had someone had bought an option from me,
Mm-hmm.
and I sold it. No, I
Mm-hmm.
got
Got it.
cleared.
Okay.
Yeah,
Fine. Fine. Okay. Anything else from anyone?
yeah, yeah. It's a last question.
Yeah,
That
please.
you are teaching in Excel right now.
Mm-hmm.
Okay, so after completing maybe FRM, when we clear,
Mm-hmm.
so when we maybe if we get selected, so at that place,
Mm-hmm.
like the job location, do they teach us these things, or we have to do it ourselves? Like,
See, it would be better that if you become proficient in these things yourself before starting your, career. That is always better, because although, yeah, there is some kind of training, but I don't think they teach these things in detail from basics, not at all. I think Ujjwal, Vedant, they can give you better ideas.
we
Abhiyaan,
know the theory,
Arijit, yeah,
but how to represent it in Excel?
that you should learn. Arijit can also give his feedback, I think, yeah. Anyone who would
In
like to.
fact, they would expect you to pull it before you go teaching.
Okay, that is the
Uh,
expectation.
yeah,
Okay, but basic Excel is enough for these things.
Basic Excel is enough. Yeah. Ujjwal is saying basic Excel training will be there, but not in details. In fact, it is possible that unit again depends on the place where you're working. But I would strongly recommend, strongly, that wherever we have the option of choosing Excel and implementing the concepts, particularly in these chapters, after the exam, please prepare these Excel files from scratch. It will be very, very good for you. Refer to the videos, see what we were doing. It will go in your mind, and trust me, you will be able to build even better Excel sheets than this. This is very basic, very raw. Okay, you'll be able to build it in a more efficient way also, with the same data being used again and again in a very modular fashion. So, but just you have to learn properly here. I mean, after the exam, just make sure you can consult me directly after the exam. Okay, and I will let
Sure.
you know which courses you can go for. And this is to everyone, those who are not very experienced, and those who you're planning to start their careers after FRM. Please discuss with me, and I'll make sure I recommend you some courses. And in fact, we are also launching financial modeling program very soon, and we are having some of our students also. In fact, from this batch also, Arijit is there, who's going to help us and mentor our students as well. So we are going to have a team, and we are going to start financial modeling courses also. So probably by I think January or February, the layout and structure should be ready. Okay, we are going to start live classes one to one for some students, but the structure will not be ready so soon. It will take some time. So by January, February, maybe we have the entire structure, and then we can discuss with all of you also. Okay.
Okay.
And
Thank you.
anyone who is interested, again, I'm saying, I think this question was floated in the group also. Anyone who's very proficient in Excel and has an experience in financial models, or even in niche areas like risk models, I mean, please contact us if you are interested in any kind of teaching engagements part time. Okay. Amit is asking also, all these calculations we won't do manually. I think system will do it for absolutely. See, in the industry, see again, for the exam point of view, you have to do the calculations. But in the industry, are you expected to, find out expected, then pay off, then choose the actual? Absolutely not. So everything will be done by the system. It's basically you have to take a call, you have to take the decision. So models will be there. Okay. And yeah, even if you have to build the model, let's say from scratch, I don't think it will be basic models like this, right? And absolutely, Nathan, we are in the age of AI, so all these things. But yeah, again, still why it's important to learn, because you can use AI to your benefit even in a better way if you understand the basic ideas also. Right. See, I mean, we are hearing a lot about, there will be no requirement of coding and all those things in the future, because now it will be mainly done by AI, and AI models are, of course, generating much, much better and efficient codes now as compared to programmers. But still, yeah, I mean, there have to be, say, and I also agree to the fact that even for judgment, there is a possibility that AI models might even be taking better decisions and even doing subjective analysis better than human. That is also possible, because once you give this argument that you don't need programmers, AI will do the job and everything. So another counter argument comes that, but what about interpretation? What about decision making? I say that even that part is not required. Even that can be taken care of by AI. But the issue is that still at the highest levels, there will be cases where human intervention will be required. And also, we have to think about regulations as well. Where are we going? I think this discussion with us is also going to be mainstream in the next 5 years. Not only the development of AI, I mean, regulations will also be one of the key factors which is going to influence how much human intervention is required. For example, I'll just give you an example. Forget about finance right now. Let's discuss robotic surgery, right? Surgery is something which was never imagined to be carried out by robots or uh, uh, AI related, you can say, machines. But even before the advent of AI, even before the advent of AI, even though I should not say advent of AI, even before the large scale uh, inclusion of, say, Gen AI and large language models, even before that, I think in the last 10 years, surgery has evolved to such an extent that we already had robots doing surgery. I think many of you might have heard of Da Vinci, right? Da Vinci robotic surgery. So basically, even complex surgeries like a triple bypass is now being carried out by this Da Vinci, and even without any kind of intervention from the doctors. Doctors is just there to manage, monitor. Even top hospitals in Bengaluru, in Gurgaon, with the top quality surgeons. Okay, they are also just trying and supervising the entire team and giving them training what the machine is doing, but the entire operation is being carried out by machines now. In India, though, chalo, still there is some level of human intervention, even in surgery, triple bypass, full robotic surgery, also there is some intervention. But go to countries like China, where you have 100%, I mean, from start to end, without any intervention, the surgery is being carried out. And these things are going to take place. But again, what about regulations? And what about how much we want to allow? That is also probably going to be some, maybe when these languages prosper a lot, and there are challenges with respect to, I don't know, maybe employment or anything else, some ethical constraints, then these discussions will become mainstream, right? We all saw what happened. I mean, of course, it is not, uh, uh, I'll say it's loosely related, if not directly related. We all know what happened with crypto, right? I mean, Bitcoin was in existence since what, 2008, 9, correct? If I'm not wrong, right? That was the first time we heard about Bitcoin, correct? But how much time it took for regulatory agencies and governments to start uh, plugging in the switches? How much time? I mean, I think 8 to 9 years at least, when we started talking about the regulations, when blockchain technology was evolved to a very large extent. So the same thing may happen with AI also. After some time, we may see some kind of regulations, and which may actually slow the pace if required. Maybe, I'm not sure it will happen, may or may not be true. Okay, but anyways, as of now, we should try and learn as much as possible. Gen AI, agentic AI, LLMs, and even if you're not from science background or programming background, at least the least you can do is to learn RStudio or Python. That thing can be done, not without too much of fuss, right? It will hardly take a few hours of your investment per week after the exam. Not like the FRM exam, it will not be very intensive. You can definitely learn a tool, not a problem. Okay, fine. So we'll just end this session. Thank you very much. Bye.